For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Yeah, this is Bucket Strategy Investing. Thanks so much. Welcome back to the program as we just plug along here, working our way through the summer. I'm Johnny Dean, your podcast host, here with my good buddy, Professor Rick Plum. Are you taking any time off at all, or are you just...
I'm actually not here right now. I'm in the Midwest somewhere.
That's why I thought I'd mention that, because, you know, we do these ahead of time, and I know you're... I don't know where you are.
I'm not sure where I'm going to be either. I know where I'm going to be at certain times.
How long are you out for? Let's put it that way.
A month.
A month? Really? What's the goal here? Just cruise?
Yeah, I'm going back to a wedding reception in upstate New York.
Okay, so you're driving 3,000 some odd miles.
I decided to drive it. I'm going to see my kids in Denver. I'm going to see my other kids in West Virginia.
Now, is it just you?
At this point, yes.
Wow.
Yeah.
Oh, okay. Well, anyway, so you're doing that, and you're going to take a whole month and drive around the country and see the sights. You might decide, hey, I kind of like being on the road.
We'll see.
It is fun.
I've never had the opportunity to see a lot of it.
It is fun. Anyway, welcome here to your podcast, to my podcast, I'm trying to continue some themes here, Professor Plum. This is kind of where we've been going this whole last season, this season, and even in parts of last season. As I kind of want to keep hammering home this particular point, because I sometimes go online and I say, okay, I want to talk about bucket strategy, but as I look at bucket strategies and I see what other people claim is a bucket strategy, I go off and I look at what are the criticisms of it. And we actually did a show on this a few months ago, and kind of listed them and said, well, this is why they're wrong. But okay, one of the criticisms that I've seen, and it's wholly not valid, but one of the criticisms is that the bucket strategy does not put enough money into what might be called the best historically performing asset class, which is stocks. Okay?
Well,
they say, well, you got all this in safety, okay? You got, 5, 6, 7 years in something that's not going to earn much. It earns more now than it did, but it's not earning much.
It doesn't have the same earnings today that the average stock market return has.
No, and the bucket 2 is very similar to that.
It's a crossover.
A little better, but the bucket 3 is what we call the equity or stock bucket, long-term bucket.
And this is not a new criticism. We heard this criticism back in the 90s. We heard it a lot towards the end of the 90s.
when everybody was...
And the problem is the best performing asset class, they're saying, is stocks. And over long periods of time, that is probably true. We're throwing some real estate there too.
Well, when you compare it to CDs and things like that.
Average rates of return over 10, 12, 15 plus years, stocks outperform. At least they have... Yeah. But that's the problem that we're getting to.
Well, so let's talk about this. Now,
the best asset class for what?
Well,
for what I'm trying to accomplish today or for what I'm trying to accomplish over the next 15, 20 years.
So the other method that's popular, and although it's losing popularity, is this so-called, and we've talked about it before, systematic withdrawal, a balanced portfolio and a systematic withdrawal. Can you just take 15 seconds and explain what we mean by that? What is that?
Typically, they're using a balanced portfolio of stocks and bonds, 60-40 stock bond, 50-50 stock bond, and they're maintaining that allocation relationship. So the bonds and the stocks are going to stay 60-40, 50-50, or whatever they set up at the beginning. And you're going to take a distribution each year or each month of a specific amount. The 4% rule was based on a systematic withdrawal from a balanced portfolio. A lot of studies have been done on how much can you normally withdraw or reasonably withdraw from a balanced portfolio, and when will I run out of money type of things. And they're all done on systematic, balanced approaches where this is where the 4%. So if I got $1 million, I may have 500,000 in a bond, in different bonds, and 500,000 $50,000 in stocks, diversified, because you want to be diversified.
50,
and then
50.
each year, if one does better than the other, you rebalance it. But you're also taking distributions, systematic. In this case, I'd be taking $40,000 a year, $3,333.33 a month from this portfolio. Whether it earns that much in interest, which it won't, especially back for several years ago, you just sell assets. You sell stocks or bonds within the account and take your distribution every month, and you then at the end of the year rebalance back to 50-50.
All right, so that's the systematic withdrawal method we've talked about. Now, first of all, quickly, why do people do that?
Because it's really easy.
There you go. And is there any other reason, if you took ease, forgetting ease of anything, is there any other reason that you can see why somebody would do that?
Because it's really easy.
Okay, there you go. Now, okay.
Well, and it comes from using averages. And the old story was, well, the stocks average, call it 10% a year. If I'm taking out 6%, I still have 4% left in that can reinvest for inflation. My portfolio will grow. On average, it sounds very good. And for someone who doesn't delve into the numbers, doesn't understand the difference of what's happening, that makes total sense. It averages 10%. I take out 5, I leave 5 in it, or whatever the numbers work out to be. And I should never worry about running out of money. The problem is...
Yes, now I want to ask you this. Why do you not advocate this, and what is wrong with that? Now tell me what's wrong with that.
Because averages are based on long time horizons. They don't happen every year. The stock market does not go up 10% every year. One year it may be up 25, 30%. One year it may be down 20%, 15%. And that was just in the last 5 years.
Yeah.
I mean, you look at 2021, it was up close to 29%. 2022, it was down 20%. In those down years, not only did I not earn enough to take out what I'm going to withdraw, I didn't earn anything, and I lost a bunch of money, and I'm still going to try to take out the same distribution. Now I'm selling at a loss, and that has a dramatic effect going forward. Now, luckily, 2022 was a bad year, but it wasn't that long of a recovery. We've basically recovered a couple of years later. If we have another time period, 2007 to 2009, 2000 to 2010, where it took 10 years to recover, 72 to 73 down market took 12.8 years to get back to T-bill rates. Those are the types of downturns that can have a devastating effect on an overall portfolio if you're not prepared for it. If you're selling when the markets are down, you're asking for trouble.
So you're saying that the problem with that is that it creates risk in the sense that you need that strategy if you're going to use it. That strategy, a systematic withdrawal approach and a balanced portfolio, that strategy needs to work 100% of the time. It can't work only 70% of the time. You need a 100% success rate in order for that. In other words, the markets need to always go up.
Right. Or at least for the first 10 to 15 years, they need to always go up so that you're still taking 4% of the original portion out, but your portfolio's grown a bunch. And it does happen at times.
10 to 15 first 10, 15 years?
We're good, yeah. You look at 70...
I wouldn't count on that, though.
79 to 2000 were, for the most part, very good, positive years.
Yeah.
It worked there. It didn't work almost any other time.
But if you zoom out, do you ever notice these 20 to 25 year periods where the stocks do very well for these 25 years?
But there's a lot
and then there's another 25 years where they don't do so well.
I've seen that, but also even in the good years, depending on what you're taking out, when you're taking out, your timing matters.
Yeah,
and unfortunately, you talked about the critics say that you're not in the best performing asset class. Well, the best performing asset class is not the same asset class year in and year out. Not even over 5 year periods of time. They change.
Yeah.
When you go out to 10, 15, 20 years, you start to see the same asset class being at the top of the chart. But that's not on a shorter period of time, and that's the problem.
Yes,
it's the short period of time where the volatility, which is going to be there, is your nemesis.
Mm-hmm.
And unless you can show me that you can pick what the best performing asset class is going to be before it's the best performing asset class each year, each 4 year, 5 year period of time. I've never found anybody that can do that. Unless you can pick what's going to be the best performing asset class, you can't play that game. Well,
and that's why this is the type of strategy that we're describing that we do not like. That's why this strategy has to work 100% of the time. In other words, there's no margin for error here. You cannot have the first 3 or 4 years be bad when you retire and still take a lot of money out. You just said that.
Right. It will have a dramatic effect. I mean, if you're not the healthiest person in the world and you don't expect to live, more than 10 or 15 years, you can.
But then you don't have a long time horizon.
You don't have the same time horizon.
But let's just.
And now all you're doing is rolling the dice and playing with the odds, hopefully in your favor, but not.
Most people don't do that. Most people don't know what's going to happen. They assume they have to assume that they're going to live another 20, 25, could be 30 years. They don't know. All right. So that's the problem with the systematic withdrawal method. Now, let's turn to buckets for just a second. And we'll address that criticism that not enough is in the historically highest performing asset class of stocks. I'll just say stocks being an asset class. If you had a $1 million portfolio, Professor Plum, take 20 seconds and tell me I need $40,000 a year out of it. How would you bucketize that in just using 3 simple buckets?
In very simple terms, you might have, if I want 40,000 for the first 7 years, that's 280,000, not including any earnings and not including any mathematics for inflation.
All right.
With the way the math works, you'd probably have another 300,000 in bucket number 2.
So you have about 300 in one, about 300,000 in another.
Rounding up, giving ourselves some room for error. So that means you have 400,000 left over for that, what they consider to be the best performing asset class, rather than all million in it.
Right. Okay. So now you've got 40,000.
But my best performing asset class now has been defined by the time horizon I'm dealing with.
Yeah.
And I'm not taking any risk with my cash flow in the first 7 years because it's in very safer. And my best performing asset class, I am using it for the time horizon that it has created that best performing asset class value. I mean, it's got me, now I'm in a position where those averages are more likely to come true.
And if something does go wrong, if you wind up retiring and the next 2, 3, 4, let's say of the next 7 years, you have 3 bad years in those. Does it matter? It'll weigh on your psyche. Everything does.
I mean,
does it matter?
But your cash flow is set. You've got your cash flow done. You're not selling when it's down. You've given yourself time for it to recover.
Then there's your key word right there, Professor Plum, in my mind, the word time.
Uh-huh.
Time. They used to say, and I guess they still do, that time mitigates risk. The more time you have.
Time heals all wounds.
This going all the way through history, though, that's been the case. Name a problem that time has not solved. Time solved the Black Plague eventually, right?
Everybody died.
Well,
enough of
them. Well, but I'm just saying. Every single problem in the history of the world has been solved by time,
and every single crisis in the stock market has been solved with time. Now, we talked about the market, which means diversification. So I'm not talking about an individual stock because they can go out of business.
Well, yes, of course.
But the market is not going to go out of business as long as we have an economy. And if we don't have an economy, well, nothing really matters at that point anyway.
Okay.
But time has healed all crises. Every one that we've had, time has recovered all the money you invested in the market.
Correct. Okay, so the whole point of this, then, Professor Plum, is to have time. In other words, you need longevity with your portfolio. Is that correct?
It is, but to get that longevity, you need to not touch it for a period of time, for that stock portion.
Correct. So you need longevity. So here's my dilemma as, let's say, a retiree, okay? I say, I know I need time. I know I've got a certain amount of stock. I got a certain amount that there's money in stocks here, and I need it time to grow. But my other problem is
I need money now.
I need money now. I need cash now. What's the song? But that's true. I won't. Okay, but I need it now. So this is the whole retirement dilemma.
Right.
I need time to let the stocks grow, but I also need cash now. And this is what buckets, this theme we've been going through over the last several episodes. This is what buckets aims to solve.
Yeah, I mean, the whole idea is to be able to create a predictable, stable cash flow that is not reliant on the market in the short term being multiple years, and allow the assets that do have the potential to get that better average rate of return time to get that better average rate of return.
Now, if you only have 400,000, 40% of your portfolio in stocks versus somebody who has 80, 90, 100% in stocks, you are potentially over the short run going to do less well from a rate of return standpoint than somebody who is all in the market and just happens to find, 8, 9, 10 years where stocks have done well. Now,
and it happens at times,
yes,
where that's going to work. Where being aggressive, just like in gambling, sometimes being aggressive works,
yes,
and sometimes it doesn't. And so, what is going to happen is your luck going to be positive over the next 7, 8, 10 years, or is your luck going to be like the rest of us over the next 7, 8, 10 years?
So, not putting your pedal to the metal and the thing to the floor. I mean, I read this quote, and it's to me, it says it all. Somebody once said it's counterintuitive, but you will likely maximize investment gains over your lifetime if you go out of your way not to maximize annual returns, instead focusing on merely good returns that you can sustain for as long as possible. Would you rather have 2 or 3 years of 20% returns and then rotten returns, or would you rather have 30 years, I'm just making an example, 30 years of 5 to 6 to 7% returns? Well, I would personally rather have the 30 years of 5 to 6 because I've got compounding working for me in that case.
Well, the problem is, if you could guarantee me that I'd have the first couple of years of 20s, but you can't, because to get that 20% potential return, you got to accept a minus 20 in 1 or 2 of those years too. That's the crux. And so that's the issue. Now, when you said, we were talking about earlier, something came up. We're putting 60% in bucket 1 and 2 and 40% in bucket number 3. That sounds an awful lot like a balanced portfolio.
It sure does. 60-40 does.
So how is that different? How is that bucket plan different than a systematic withdrawal?
Good point. Talk about that.
Because we are not taking a distribution from anything that has volatility in it. We're not rebalancing the portfolio every year just for the sake of rebalancing, and we're not selling assets to create the cash flow that we need. But buckets is up front is it's an asset allocation tool. How much money am I allocating to specific types of investments? But unlike a balanced portfolio, we're saying, well, we're going to be 60-40 because that's a balanced portfolio should be, and then we're rebalance it. We're identifying how much money should go into bucket number 1 based on the need of bucket number 1, and how much money can go into bucket number 3 based on the need for bucket number. We're identifying what you can and can't do with the money and how you can and can't invest based on risk, not some arbitrary 60-40, 50-50 balanced portfolio. And the key is we don't take distributions to meet our monthly needs from that volatile side of the portfolio. If the market's down 20 or 30%, we don't rebalance it. We let it ride. Now, we could rebalance it. I mean, if we start off with 300,000 in bucket number 1 and we want 7 years of income and the market drops 47% or whatever it was like in 2008, I say, what, this is a buying opportunity. We're down pretty good. Maybe I'm in year 2.
Yeah.
Maybe I take year 7's money and put it into the market. I still have 6 years.
So you're going from bucket 1
to 3
bucket 3
when the market's down like crazy. Or going conversely, the market goes up 30%. And that's not unrealistic. It has done it.
Right.
And so I go way up. It's like, maybe I fall back into the old adage of at some point we regress to the mean. So if it's up 20, 30% this year, maybe it'll come down. Now, maybe it won't. Maybe it'll go up again. But maybe I take some of that extra profit. I thought I was going to get 10. I ended up with 30. Let's take 10 or 15% of that extra profit and put it back into bucket number 1 and stretch my time horizon out again. So there's still management. And this is why what I talked about, the systematic withdrawal is just easier to do. I can set a computer to do it. I don't even have to be there to do it. A computer will do it all for me. This is something that you have to actually kind of manage from time to time. Not daily, not nightly, not weekly. You don't wake up in the morning and say, oh no, the market's, you manage it periodically, but you know that you've got time for it to run. You've got everything. Mm-hmm. You've done as much stress testing for it in the short run to be comfortable with what's going on. Now you're just looking for either an opportunity or, opportunity because it's down,
right,
or an opportunity because it's up.
Well, and
what a shame. I'm looking for opportunities, not for scariness.
Well, okay,
scariness.
So two things this brought up here, Professor Plum, your point. Number one, it pointed out the importance of this margin for error. When things don't go according to plan, either they go up, you didn't expect it, but when they go down, you've got a little margin for error, and it's not going to hurt you.
You have to do anything. It just means it could be an opportunity.
The other thing that you said several times is the word, again, time. You are buying time, because time, when it comes to longevity, when it comes to survival, time is your most important element.
Yeah. And when they talk, and that's the fallacy of that initial report, that initial criticism that you don't have enough money in the best performing asset class. Well, the best performing asset class over 1, 2, 3 years of time is not always the stock market. And so they're making the blanket assumption that the best performing asset class is always the stock market. That's not a true statement. And I should not be pulling money out of a portfolio that can go down. So they're basing their whole premise of criticism on a fallacy.
Well, that's true. And you shouldn't be worried about things like rate of return over the short period, over the short term.
You worry about it. You just don't leave it in your mattress. You try to get as much rate of return given the parameters that you've set forth. But rate of return is not the primary focus.
Well, let me ask you this, Professor. We went through 15 years of interest rates. Your bucket
and
one.
We tried to get the best rate of return out of bucket number one we could.
Well, you did,
but it's not the primary focus.
No. So here's the thing: you've got an asset class, and I'm just going to group these into, let's say, CDs and non-volatile money, right? Stuff you can draw from, earning 1% if you're lucky, right?
At the time.
And then you've got certain periods of time where this other asset class, stocks, has been returning 15%, 20, 10. It happens. Yet you're still sticking with the 1% short-term money.
Is that 10% that you received last year going to happen again this year in the stock market?
Yeah, I can't guarantee that.
No, and because I can't guarantee it, it could have a devastating effect on my portfolio. And when I'm 25, what do I care about that? Because I'm just going to buy more with my 401k every pay period.
No.
When I'm 65, 75, 85, I don't want to be selling anything that's in a down position. So I cannot take that risk. And so I can't say that at that point, the safety and security and the stability of the lower yielding safe accounts makes more sense. That's SENCE, not CENTS, than trying to get that 10% rate of return for that amount of money. But it doesn't mean you shouldn't have some money in the stock market. I mean, I've had a lot of people that say, I'm 80 years old. What do I need a bucket number 3 for? And it's like, because you want to guarantee that you're going to die in 10 years, 12 years, 15 years?
Yeah.
What if you live? You still want to have some money. And so what's the best asset class for that 15 year period of time? Just in case, dadgummit, you live.
Looking out over the long term and not sitting there selling and moving things around and trying to chase, oh gosh, I only made 9% this year. I should have made 12. And you know what happens when people start to do that? They start messing around with their stocks and they start selling and buying what over here and trying to, as we've said,
they're looking for the next big winner,
right? Because they want to. I want to make money now.
And most of the time, the big winner comes out of the blue, and you're like, oh man, I would never have guessed that one to be it, but it did.
We talked a week or so ago, whatever it was, about the third member of the Charlie Munger, Warren Buffett, and Richard
Guerin.
Yeah, Guerin.
Richard Guerin.
Right. Who said who tried to just make it all up front.
He was very aggressive. And Buffett said he was smarter than he was, but he wanted it all now.
Wanted it all now. And that's probably the worst thing that you can do. And this is what a bucket strategy, I believe, aims to take. It aims to take that option out of it. In other words, you do not need to have. You do not need to make 20% this year. I mean, if you do in your bucket 3, fine, but it's not what we're after. The fellow by the name of Carl Richards, I don't know if you've heard of him. He's a New York Times, or was. He used to be a New York Times financial person. He did these things called weekly sketches, and they were kind of funny. But he once made the point that a house might be the best investment that most people ever make, their primary residence. It's not that it provides great returns. It really doesn't year to year. It's not
especially considering the maintenance.
Well, yeah, and it's not even the leverage. He said that the reason it does is people are more likely to buy a house and sit on it without interruption for years or decades more than any other asset. So it's the one asset that people kind of give compounding a fighting chance to work.
Well, and I've mentioned this about the stock market versus real estate investing. The reason many people do better in real estate than stock picking is that it's difficult to get rid of it when you're mad at it.
Well, that's it. You can't just sell it and you leave it alone.
And you end up holding on to it long enough that it works. Where with a stock, you wake up and have a bad dream. You can put in a sell order on your computer that moment.
That's the problem there, you see? And we have to take that out of the equation if you stick with your strategy. And that's when people don't
with
panic.
Those real estate investors, that they were able to survive. They weren't over leveraged. Those are all things that can screw up real estate for anybody.
I just brought that up as an example.
No,
but
I
people will own their home for 20, 25 years. Generally, people who do that have made some money.
Yeah.
And only because compounding has taken enough time. Again, there's that word time that allows you to have that flexibility.
Yeah.
And it's almost like magic in some ways when you think about it.
Well, wasn't that what Einstein said, something about compounding being the greatest?
Well, it was the one thing he couldn't wrap his head around. It was he was astounded by the whole idea of compounding.
But compounding takes time to work. It doesn't work very well over 2, 3, 4 years because you haven't given it enough.
It doesn't.
Time.
Well, have you looked at? I think I've said this before on this program. We talked about Warren Buffett. What is he worth? I don't even know.
Billion. I don't know.
A lot of money.
More than me.
Most of his money was made over the last
in the later years.
Yeah, 5 to 10 years. I mean, maybe 15 years. The guy's been investing for 70 some odd years, 80 years, whatever it is, okay? Most of that, of his wealth has been accumulating over the last 10 to 15 years because of compounding.
Right.
I mean, 10% of $1 billion is a lot more than 10% of $1,000.
I was also reading something about him in the Berkshire Hathaway, the company that he runs, that has done so well and so famously well for everybody. One of the reasons he attributes some of the success to it is that it's a C corporation, and he didn't have to worry about raising cash to buy out people that wanted to sell.
Yeah,
he had a constant set of values that he was working with. He wasn't dealing with dollars out, dollars in, dollars out, because it's people that wanted it bought the stock, not from him, but from out in the secondary market. So he wasn't worried about cash flow.
Yeah.
He was able to invest for the long term.
You see?
Time. He wasn't worried about creating cash flow from it because he wasn't worried about redemptions and things of that nature. So he had a different style of investing versus some mutual funds and other things that are open-ended.
Well, that's it. So it's all about buying time. If there's anything you want to take away from this particular episode, it's about buying time, having the time to let what compounding needs to work. Let that work in your favor. You buy time by having some non-volatile assets because you got to have some money to live off of.
Yeah.
And you take those non-volatile assets, you live off of those. And as opportunities present themselves, whether the markets are up and you can maybe buy yourself a little more time, markets are down, you can buy yourself maybe potentially some extra long-term money or assets.
You brought up something, buckets isn't just for retirees, but it's just how you interpret it. The 30-year-old, 40-year-old, do they need a bucket number one? Well, they need an emergency fund. They need to be able to cover unexpected needs for cash that they may not be able to cover out of their ongoing cash flow. But they need to have an asset that creates cash flow for them to live on. They are bucket number one.
That's their job. It's their income.
They are the asset
yes.
that creates the cash flow.
Good point.
So they are bucket number one, and in many cases, bucket number two, because they're going to be working for more than 15, 20 years still.
Well, I would hope so.
Unless they can get that bucket number 3 to really grow really well.
Oh, I used to be in that position years ago. I don't know. It's nice where I am now, but would you trade all this for your youth again? I don't know.
Considering the damage I've done to my body, yeah.
You didn't think you'd be here this long with all the...
Man. That old saying is, if I'd known I'd live this long, I would have taken better care of myself. Oh, gosh.
We were just talking earlier about
another friend of ours had a little accident.
Who had a bicycle accident. I said, well, they pulled a plum. And you said, nah, this person only broke 6 ribs.
Yeah,
I think you broke...
half a plum, yeah.
Yeah, half a plum. Anyway, but you have to count on longevity. And I think you're a good example of that. Mickey Mantle was the other one. He actually lived. Yeah, you just don't know. You could live to be 90, 95, and it's important to understand how time can work in your favor. Good stuff. This, if you want to talk more about buckets and you want to learn how to bucketize, got a couple of options here. First, if you just want to read about it, go to our website, luciacap.com, luciacap.com. Download the Bucket Strategy Guide. This has been a very popular guide. Type in Bucket Strategy in the search bar at the top. You'll see it should be the first thing that comes up. You can download it to your device, whatever, read it at your leisure, and learn all about it. It's 30-some-odd pages long, but as I've said many times, you read the first probably 4 pages, I think you've at least got an idea of how buckets work. Get the concept down, and then go into as much detail as you want. It's I really think, Professor Plum, that it's vital people understand what the bucket strategy is versus just somebody who says, I'll put two years in safety and the rest in stocks, and I've bucketized you.
Well, I showed you, I had to take a CE class. And it was
Continuing education.
Yeah, I'm sorry, yes. The title of it was Distribution Methods. And
Oh, yeah.
And one of the methods was the buckets plan. But this is teaching, in our industry.
Versus real life. Yeah.
They were talking about bucket number 1 being 1 to 3 years, bucket number 2 being 3 to 5, 3 to 6. And then bucket number 3 being 12 to 15. It's like, wait a minute. First off, that's too short for bucket 1 and 2. But what happened to that middle ground from 7 to 12? They forgot all about that money.
The lost years? I don't know. Is it the missing 18 minutes of the Watergate tape? What is that?
I was like, well, CE on this, huh?
And by the way, that's an old reference. I got to stop making Watergate.
Oh, the 18. Yeah, Watergate was 73?
72, 73. Yeah, I got to stop making this. 50
right
years.
It was right when the 72, 73 market downturn
I know
happened.
that.
Correlation? Coincidence?
And you got a guy named John Dean sitting with you, right?
Yeah, out of jail now.
He was only at Fort Holabird for about 6 months. So, All right. Anyway, luciacap.com. You want to talk to Professor Plum or any of the Lucia Capital Group advisors? If you don't have a bucket strategy, and especially if you're retired and you're nearing retirement, it's time to talk to Professor Plum. Or, as I said, any of the Lucia Capital Group advisors. They'll help you out. 800-644-1150. You heard all the information today. There's a lot more of that where that came from. Give them a call, 800-644-1150, or as I said, you can go online to luciacap.com. Don't forget to subscribe to this podcast. As I tell you every single week, do not miss a week of this show. You're going to miss a lot. Podcasts, Apple Podcasts or Spotify, those are the 2 places you'll find this, and listen to this program, download it to your device every single week. Once again, Professor Plum, I thank you.
Yeah, thank you. You're welcome.
Wherever you're traveling right now, I don't know. I may be traveling myself. We may both be on the road.
We'll be doing this we'll be phoning it in.
Don't think I've ever done that, but it's been years. Anyway, for Professor Rick Plum, by the way, did I say you're a certified financial planner professional?
I don't recall.
CFP?
Yeah, I am one.
Yes, and an accredited wealth management advisor.
Yes, AWMA.
See?
You got it.
I had that down.
That's the newer one.
You're both of those. All right, I'll remind people of that. For our buddy, Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks again for listening. We will talk to you again next week. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. An asset allocation strategy does not ensure a profit or protect against loss. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Richard Guerin and any other individual or company mentioned in this podcast are not affiliated with Lucia Capital Group or LPL Financial.